Welcome to this explainer. We're going to do something today that might honestly seem a bit impossible at first glance. We are going to take the dense, complex legal text of India's cost audit regulations and break it down into a simple, step-by-step compliance funnel. You know, if you're operating a business in India under the Companies Act of 2013, navigating the rules around cost records and audits can literally feel like wandering through a maze blindfolded. But today, we're going to knock down those walls and give you a crystal clear, linear path to understanding exactly what the law demands of your organization.
So here is the big million-dollar question we're answering today. Does your business fall into a non-regulated sector? And if so, are you absolutely certain of your legal obligations? There's this huge misconception out there that if your industry isn't heavily regulated, like say telecommunications or electricity, you're just automatically off the hook for cost audits. Well, spoiler alert, as we'll see from the company's rules of 2014, that is absolutely not the case. We're going to figure out right now if your non-regulated business is legally required to conduct a cost audit.
To figure out exactly where you stand, we'll navigate 5 straightforward steps. 1. The non-regulated sectors. 2. Rule 3 on maintaining cost records. 3. Rule 4 covering the audit thresholds. 4. Exemptions to the rules. And finally, 5. Section 148 versus 143.
Let's dive right in with Step 1, the non-regulated sectors.
Now, the government actually casts a surprisingly wide net here, capturing a massive variety of industries under specific Customs Tariff Act or CETA headings. And we aren't just talking about niche, obscure manufacturing. If you produce anything from milk powder and insecticides to plastics, tires, paper, textiles, glass, or even if you provide education services that operate as a business rather than pure philanthropy, guess what? You are officially entering the funnel. The government specifically uses these CETA headings to classify products, which means there is zero ambiguity about whether your specific output is on the list. And the regulation also gets incredibly specific, especially when we talk about medical devices. Under CETA headings 9018 to 9022, the rules explicitly list out 20 distinct categories. This covers the production, import, supply, or trading of literally everything from cardiac stents and bone cements to pacemakers and spinal implants. If your business touches these highly specific items, you are firmly in the non-regulated sector bucket for the purposes of these rules.
Moving right along to Step 2, Rule 3, Maintaining Cost Records.
So, what's the magic baseline number for Rule 3? It's an overall turnover of 35 crore rupees. This is the first major financial filter in our compliance funnel.
Let's unpack what that number actually means in practice. Rule 3 states that if your company's total overall turnover from all its products and services hit 35 crore rupees or more during the immediately preceding financial year, you are legally obligated to include cost records in your books of account. This applies to domestic companies, sure, but it also ropes in foreign companies as defined under the Act. However, there's a pretty important lifeline here. It explicitly excludes companies classified as a micro or small enterprise under the MSME Act of 2006. So if you hit that 35 crore mark and you aren't an MSME, well, congratulations, you've just passed through the second layer of the funnel. You now have to maintain detailed cost records that track per unit cost of production, cost of sales, and margins.
Which brings us to Step 3, Rule 4, the audit thresholds. Now this is where the funnel gets a little narrower. You've hit the threshold to keep the records, but do you legally need to get them audited? Rule 4 creates 2 distinct sets of thresholds, separating the regulated companies from the non-regulated companies we're focusing on today. Notice how the government actually gives non-regulated sectors a bit more breathing room here. For heavily regulated sectors, the audit triggers at just 50 crore overall turnover. But for our non-regulated folks, the threshold is significantly higher.
Here is the absolute key takeaway for your non-regulated business. An audit is only mandatory if 2 very specific conditions are met simultaneously in the preceding financial year. First, your overall annual turnover from all products and services must be 100 crore rupees or more. And, second, the aggregate turnover of your specific individual products or services that required cost records under Rule 3 must be 35 crore rupees or more. To put that into perspective, say you hit 110 crore in total sales, but only 20 crore of that came from those specific plastics or medical devices we looked at earlier. In that scenario, you still maintain the records, but you do not need the audit. You have to hit both that 100 crore total and the 35 crore specific product turnover to trigger a mandatory cost audit.
Okay, Step 4, Exemptions to the rules.
Now, even if you smash right through those massive financial thresholds, there is still a chance you get a pass. The rules provide 3 specific legal escape hatches.
Number 1, you are completely exempt from the audit cost if your revenue from exports, specifically in foreign exchange, exceeds 75% of your total revenue. Basically, the government doesn't want to overburden heavily export-oriented units. Number 2, you're exempt if your company operates from a special economic zone, or SEZ. And number 3, you are exempt if you're engaged in generating electricity for captive consumption through a captive generating plant. If any of those 3 scenarios apply to you, you are totally out of the audit requirement. Though, keep in mind, you still have to maintain the baseline records under Rule 3.
Finally, Step 5, Section 148 versus 143.
I hear executives ask this all the time. We already do a massive, exhausting financial audit with our chartered accountants every year. Why on earth do we need this too? Well, this perfectly illustrates the government's stance. Your cost audit is not a replacement. The law explicitly states that the cost audit conducted under Section 148 must be entirely in addition to your standard financial audit conducted under Section 143. They serve 2 totally different purposes. The financial audit ensures the integrity of your overall financial statements for the shareholders. The cost audit, on the other hand, provides granular, product-level efficiency and cost data, ensuring total transparency in how you utilize your resources.
So, putting it all together, taking into account your specific products, that 35 crore record-keeping threshold, the 100 crore audit trigger, and those 3 exemptions, where exactly does your business stand in the compliance funnel today? And maybe the more important question to leave you with is this. If a mandatory cost audit uncovers operational inefficiencies you didn't even know existed, can you really afford not to be analyzing this data regardless of what the law demands?
If you've ever looked at the dense legal landscape of corporate finance compliance and felt like you were drowning in an absolute alphabet soup of forms, rules, and tight deadlines, well, you are definitely not alone. Today, we're cutting through all that noise. We're going to look specifically at the absolute lifeblood of cost accounting regulations under the company's rules of 2014, which are Rule 5 and Rule 6. We'll map out exactly how a company legally maintains its cost records and the incredibly rigorous process of appointing an auditor to review them.
To make this super easy to digest, here's our roadmap. We're starting with the foundation in Rule 5, then moving into appointing auditors, handling sudden vacancies, getting that final sign-off, and we'll wrap up by decoding those compliance forms. But before we get into the exact nitty-gritty of the rules, let's start with a really fundamental question. It helps us understand why tracking costs isn't just some random administrative chore. How does a company actually prove its true cost of production? I mean, it's one thing to say you know what it costs to make your product, right? But in the eyes of the law, and honestly for the sake of true business efficiency, you need a standardized, totally unshakable method of proof. And that is exactly what these regulations enforce.
Okay, Section 1, the foundation, Rule 5. You simply can't audit what you haven't tracked.
So, Rule 5 mandates that every qualifying company maintain their cost records in a very specific format, which is known as Form CRA1. The rule makes it explicitly clear. Starting way back from April 1, 2014, these records have to be kept on a regular basis. Now, whether you do that monthly, quarterly, half-yearly, or annually, the non-negotiable requirement is that the data must effortlessly facilitate the calculation of per-unit costs, your cost of operations, and your overall margins for literally every single product or activity.
And just to give you an idea of how deep this goes, Form CRA1 categorizes expenses across 30 incredibly specific headings. They don't miss a single operational detail. We're talking everything from your basic material and employee costs, right down to utilities, pollution control, depreciation, and research and development. It's exhaustive. Honestly, if you bought a paperclip for the break room, there's practically a heading for it. The idea here is that no cost whatsoever slips through the cracks, giving both you and the eventual auditor a flawlessly categorized map of your operations.
Which brings us to the why behind Rule 5. The regulations explicitly state that these records exist so a company can actually exercise control over its operations to achieve optimum economies in the utilization of resources. Yes, obviously it provides the data you need for regulatory compliance, but fundamentally, it forces a business to maintain the kind of granular oversight that maximizes efficiency. It's not just red tape. It's literally a blueprint for maximizing your profit margins.
Section 2. The Overseer. Appointing Auditors. Let's look at the mechanism of accountability in Rule 6.
Now, there's a really strict separation of powers here that's super interesting. You might naturally think, hey, we already have a financial auditor, let's just use them. But nope, under the rules, your regular financial auditor, the one appointed under Section 139, absolutely cannot act as your cost auditor. The board of directors must appoint a dedicated practicing cost accountant. And here's a crucial detail. If your company is required to have an audit committee, the board has to make this appointment directly on their recommendation. It guarantees a fresh, totally specialized set of eyes.
But wait, the board can't just shake hands and call it a day. Before they officially appoint this overseer, they must meticulously verify 4 independent prerequisites. It's like a strict background check. The auditor has to submit written consent, then a formal certificate confirming they're actually eligible and not disqualified under the Act, and that the appointment falls within legal limits. Finally, they have to lay all their cards on the table by providing a true and correct list of any pending professional disciplinary proceedings against them or their firm.
And you've got to move fast because the clock is always ticking. A company has exactly 180 days from the start of their financial year to officially appoint their cost auditor. Once the board holds the meeting and actually makes that appointment, the clock resets for another tight deadline. The company then has a mere 30 days to file Form CRA-2 with the central government, or within that original 180-day window, whichever hits first. Missing these deadlines? Yeah, that's a surefire way to invite some unwanted regulatory scrutiny.
Actually, as a quick surprising historical fact, when these rules first rolled out, certain non-regulated sectors got a bit of a breather. For companies dealing in things like coffee, tea, milk powder, and certain electricals, the requirement to maintain these CRA-1 records was actually pushed back to the 2015 financial year. It's just a great reminder that while these rules are ironclad today, the initial rollout did account for different industry realities.
Section 3. Navigating casual vacancies. What happens when operations hit a sudden snag?
So a vacancy might occur for a few reasons. The auditor resigns, passes away, or gets formally removed. By the way, if they are removed before their term ends, it requires a formal board resolution, the reasons must be recorded in writing, and the auditor actually gets a reasonable opportunity to be heard. But once that vacancy happens, the board has a super tight 30-day window to plug the gap and appoint a replacement. And just like the original appointment, once the new auditor is chosen, you've got 30 days to inform the central government by filing a fresh Form CRA-2. The government essentially allows zero downtime in your oversight.
Section 4, the final sign-off. Let's look at how we close the loop. There's a really common misconception that the auditor just takes a bunch of raw, messy data and builds the whole report from scratch. Not true. Rule 6 dictates that the cost statements and all related annexures must first be formally approved by the board of directors and signed by an authorized director. The board has to take ultimate ownership and responsibility for that data before it is ever handed over to the cost auditor for their official reporting.
And to make sure these audits don't just drag on forever, the regulations put a definitive cap on the timeline. The cost auditor's mandate officially ends either 180 days after the financial year closes or the exact moment they successfully submit the cost audit report, whichever comes first. It keeps the financial feedback loop incredibly tight and relevant.
Section 5, the form decoder. Let's decode this alphanumeric soup.
This basically summarizes the entire compliance lifecycle into 4 key forms. First, you meticulously track your 30 headings of operational data in CRA-1. Then, you appoint your auditor and officially inform the government using CRA-2. When the auditor finishes their rigorous review, they compile their findings into the official cost audit report, which is CRA-3. And finally, the company must submit that report to the central government using CRA-4. It's a highly structured, start-to-finish process.
Which brings us to a final thought I want to leave you with. We've walked through the strict timelines and rigid structures of Rules 5 and 6, and I know it's really easy to view them as a heavy burden. But think about it. If you were forced by law to track your costs with the surgical precision of CRA-1, why treat it as a chore? The real question is, will you let this data sit in a government portal gathering digital dust, or will you use it as the ultimate playbook to ruthlessly optimize your margins and outprice your competitors?
Today, we're unpacking the high-stakes world of the cost auditor under the Companies Act 2013. If you're dealing with corporate financial governance, you know how crucial this is. We're going to explore the strict regulations, the rigorous compliance lifecycle, and the very real accountability that comes with auditing cost records. It's actually a really fascinating, highly structured process, and we're going to break down exactly how it all works step by step. So here is our quick roadmap for today. Section 1, who gets disqualified. Section 2, how remuneration works. Section 3, rights and duties explained. Section 4, submitting the audit report. Section 5, the 4 essential forms. And finally, Section 6, default and penal provisions. Section 1, who gets disqualified. Okay, so the law is incredibly strict about gatekeeping here, purely to maintain absolute independence.
A cost audit has to be conducted by a cost accountant appointed under Section 148. But here is the golden rule. No person appointed under Section 139, the regular financial auditor of the company, can also conduct the audit of the cost records. You literally cannot be both. The law demands a total separation of powers.
And that builds into even more boundaries to protect that independence. Under Section 141(3), there's a whole list of hard no's. First, a body corporate absolutely cannot be a cost auditor, though there is an exception if it's a limited liability partnership. Also, you can't be an officer or an employee of the company. You can't even be a partner or work for an officer of that company. And financial conflicts? Strictly barred. If you or a relative owe the company more than 5 lakh rupees, you're out. And of course, character matters. Anyone convicted by a court of an offense involving fraud is disqualified for a full 10 years after that conviction.
Section 2. How remuneration works. So, how does the auditor actually get paid? Well, it's a very specific, structured flow to make sure there's proper oversight. If a company is required to have an audit committee, that committee takes the first step by recommending the remuneration. Then, the board of directors officially appoints the cost auditor and decides on that pay. Finally, the shareholders have to ratify this remuneration later on. Now, what if a company doesn't need an audit committee? In that case, the board just appoints the cost accountant directly, and then it goes straight to the shareholders for that final ratification.
Section 3. Rights and duties explained.
I want to highlight something really interesting here. The law explicitly states that it is the duty of the company to give all assistance and facilities to the cost auditor. This is crucial because it means the legal burden isn't just resting on the auditor. The company itself is legally obligated to cooperate. They can't just hand over a massive pile of unorganized papers and say good luck. They have to actively facilitate the audit. Now, as for the auditors themselves, they have very clear operational duties. The law states that the provisions of Section 143 apply to them as well. That means a cost auditor has the exact same rights, duties, and obligations, especially regarding access to books and records, as a regular company financial auditor. They also have to rigorously comply with the cost auditing standards. And their main tangible output, they have to submit all their findings, reservations, or suggestions in a highly standardized format known as Form CRA3.
Section 4. Submitting the audit report. This is where the pressure turns up. The exact moment the financial year closes, a ticking clock begins. The cost auditor has exactly 180 days to forward their duly signed CRA3 report to the board of directors. Once the board has it, the company has just 30 days to furnish that report to the central government using Form CRA4 in XBRL format. Now, there is a slight exception here. If a company gets an extension for holding their annual general meeting, they can file CRA4 within that extended period. Oh, and one more thing. If the central government thinks they need further information, they can absolutely call for it, and the company has to provide it within whatever timeframe the government specifies.
Section 5. The 4 essential forms.
Think of this as your ultimate compliance cheat sheet. These forms flow in a totally logical, chronological order. CRA1 prescribes exactly how the company's cost records must be maintained in the first place. CRA2 is the initial notification. It's how the company tells the central government, hey, we've appointed a cost auditor. CRA3, like we just talked about, is the actual cost audit report the auditor gives to the board. And finally, CRA4 is when the company files that audit report with the central government. 4 simple forms, 1 complete life cycle.
Section 6. Default and penal provisions. So, what happens if these rules are ignored? Well, 5 lakh rupees. That is the maximum fine a company can face for defaulting on these provisions. The law doesn't just suggest compliance, it demands it, and it backs it up with some very serious financial penalties.
And they hold every single party strictly accountable. If the company defaults, it faces a fine between 25,000 and 500,000 rupees. But it definitely doesn't stop at the corporate veil. Any officer in default faces intense personal liability. We're talking imprisonment for up to 1 year, or personal fine between 10,000 and 100,000 rupees. And the cost auditor? They aren't immune either. If they mess up, they face punishments directly under Section 147. Basically, accountability is distributed across the board. No one gets a free pass. Which brings us to a final thought for you. Knowing these severe penalties, the exact forms required, and those strict ticking clocks of 180 and 30 days, is your organization treating cost audits as just a simple chore, or do you see it as the vital heartbeat of your corporate compliance? Proper cost auditing is about so much more than avoiding fines. It's about transparency, efficiency, and respecting the entire legal framework.
Hopefully, this explainer has shed some light on the incredible journey of a cost auditor. Keep this life cycle in mind, and you'll always have a firm grasp on the true stakes of financial governance. Thanks for joining me.